Thank you so much, Mr. Chhatwal, for taking time out and joining us. I would like to talk about the industry as a whole because from FY08 to FY15, it was a period when we had seen oversupply within the industry. Now, a lot of analysts are talking about supply being in single digits. With India now looking at a boom with tourism, with the kind of traffic that we're seeing for air travel, give us your sense as to how the overall hotel industry is shaped up right now.
One thing we can very clearly see that there has been a RevPAR growth in the last few quarters, and also after a long time, demand is outpacing the supply. So, as you rightly said, there's been a lot of new supply, new additions that came to the market over the last 10 years. And this is the first time that demand is growing faster. So which leads to increase in occupancies, and hopefully the increase in rates will follow when the occupancies have increased to a very healthy level.
Now, the Indian Hotels Company is an iconic name when it comes to the industry, 115 years legacy. We're in an iconic property today as well. So can you tell us a little bit about the journey so far for the company, how it's grown, dealt with all of the challenges briefly?
Well, I can't go back too much into history because it's 115 years.
Yes.
It's a lot for me too. But one thing is great that we are sitting here in the best hotel of the world, which was just rated the Taj Mahal Palace and Tower in Mumbai by Trust You as an aggregator, which makes us very proud.
Okay.
We are very blessed to have some very iconic assets, some very iconic palaces and safaris and hotel properties in all the metros. So the journey was good. It started with Taj, then we went into a multi-brand strategy, then we went into an international acquisition mode. And I think now we are trying to balance it with focusing on both Indian subcontinent and pursuing opportunistic growth in other parts of the world.
The international plans in terms of expansion have been fairly aggressive by the Indian Hotels Company. We've seen properties across geographies, a lot of marquee properties, and then there were a lot of attempts to rectify that because financially it didn't really bode well for the company. What is the strategy in place when it comes to international operations? What is the expansion that you all are looking at, or the capex, and how have you managed to salvage some of the mistakes that have been made?
Yeah, I would not call it mistakes. In hindsight, we are all smarter. So what one should have done or should not have done, I actually feel that the company did a right thing by being present in the two largest lodging markets of the world. So I think we are blessed to be present both in London and in New York. Our presence in San Francisco, or Boston, or Cape Town, or Dubai, or Maldives has been actually positive for us. So yes, one or the other acquisition sometimes did not work out the way it should have worked out, but let's look at the positives and see how we can build on that instead of complaining about one asset. There is always one or the other asset, even in our home soil, which doesn't go right. So I actually feel it's a very great platform that the company has to have the presence in such important markets and a brand name that is understood, accepted, and has the ability to win the hearts and minds of the people across the world.
Okay, as a strategy that the company is adopting, I understand it's going to be an asset-light model where you're looking at now entering management contracts instead of owning properties. Is this the way forward for the company or for the industry as a whole?
I think certain buzzwords in our industry just become like the gift of the gab and everybody just starts using them. We have embarked on a journey which we call like a smart and profitable growth model, and where we say S stands for strategic and M is for margin enhancing, which is a part of our Aspiration 2022 strategy. And you have to continuously, asset manage, that's the A, and the R is with all stakeholders by building relationships and continuously tracking your portfolio. So if there is a compelling proposition which is very strategic in a key city and actually helps us improve our margins, we would invest. We are not averse to investing money. So a one size fits all, like now it's all going to be asset light, management contracts only, this doesn't work and it's actually not the right strategy. This has come mainly from overseas companies for which I've also worked in my career. And maybe the Indian subcontinent is not a strategic destination for them to invest. But I think it's up to us, the people who've been here, the companies who are relevant for this market, to actually find the right model for themselves. So let me give you a few examples, which I've also given in the past. We take Taj Lands End that we own. The amount of EBITDA that hotel makes, you need at least 20 management contracts to replace the profitability of that one hotel. If we take this hotel, the Taj Mahal Palace and Tower, maybe you need 30 to 40 management contracts, because that's the kind of management fee income that would be needed per hotel to come close to the EBITDA of this hotel. And I think we need to do both, because when you own a property or when you own the business, your margins are lower because you also own the P&L. When you have a management fee income, it's only the management fee income getting added to the total revenues. So you don't own the business, so your profitability as a percentage is higher. Then it gets a little bit more complex when you go down the pyramid. So if we are in a what we call the lean luxury segment of Ginger, as one of our brands, maybe it's good for us to own the business and lease properties, because the amount of fees you will get on a 60 or a 80 or a 120 room Ginger would be so less that it may not justify being present with that kind of a model in any market if it was not Mumbai, Delhi, Calcutta, Bangalore, Hyderabad, etc.
Let's get down to business, talk the financials as well. Walk us through some of the highlights of the quarter gone by. You said seasonally that Q2 is the weakest of quarters. How has Q1 been for you? What have been, some of the key drivers or the key challenges you faced?
It is true that the first half of the year actually has been approximately 30% of our total revenue for the full financial year, and the second half produces 70%. And Q2 has always been the weakest quarter, followed by Q1. Having said that, we have had an 8% growth on the top line, driven mainly by increase in market share and partially inflation and the tailwinds that we are getting on the increase in RevPAR in the industry. But more importantly, we have had a 26% growth on the EBITDA margin, because our margin expanded by approximately 2%, 183 points to be precise. So given that it is after 2008, I think that we have had a profitable Q1 on a profit after tax basis, and we are happy for that kind of performance. Going forward, we feel that we will continue to deliver on our margin expansion story that we communicated to the market in February during the Capital Market Day. And if nothing significant happens in the market, if everything continues this way, I think we are well positioned to drive both margins as well as top line. One thing that has really been a game changer for us and will help us in 2 to 3 years from now is our year to date. Besides the Q1 adding whatever till 10th of August, we have added 10 more contracts to our pipeline, and day before yesterday we signed for a Vivanta at London Heathrow with a Bombay Brasserie restaurant. I think this is pretty significant in 5 months' time to have signed 10 new contracts and added them to the pipeline. And we feel from a growth perspective in adding new contracts, this will be a very important year for us.
And give us a sense as to what the outlook is on your occupancy rates as well as average room rates for most of the properties.
In a multi-brand portfolio, it's not easy to just give, like one rate for all. I think Taj is close to 10,000 last year, just a little below 10,000 rupees. So I think we will see that increase quite well, because a lot of properties have also been renovated. And one of the key highlights of our recent renovation will be when we announce next month the opening of the Connemara in Chennai. I think it will be one of the stunning openings that the country has seen. I think that should help also in driving rates. There is renovations going on in Coromandel, in Chennai, or in Bangalore in various properties. So generally speaking, the rates will increase more as of next year once the renovations are complete and you have a full year impact. And that's on the Taj brand. I think also that other brands will benefit at a minimum of 6 to 7%. So what we have reported for the quarter is 6% RevPAR growth across the entire portfolio. And some of the domestic portfolio has seen almost a double-digit growth.
Okay. The debt position, when it comes to a lot of luxury hotels as well, that seems to be the stumbling block, if you will, as it is for Indian hotels. What is the overall debt position that you're currently sitting at? And analysts are saying that by the end of FY19, we can see the overall net debt equity at less than 1 time. What is the plan for reduction of debt?
I think maybe the analysts know many things that I don't know. I think it is our endeavor to have a debt position which is smaller than what it is today.
Which is?
Today is at 2.58 times the EBITDA. I think so. It has to go down further. That would be good for our portfolio. However, having said that, it came down to 2.58 after the rights issue, which was very successfully done last year, and a lot of debt was repaid. And we hope to continue on that journey without the rights issue by paying whatever debt we can pay through our, operating cash flows.
And which category of hotels do you think is likely to be the key growth driver?
Simple answer is all. Some more, some less. As I said earlier, a larger and
But we're seeing a lot of appeal to some of the mid-scale hotels in India in particular. Is that?
Of course, that will drive the number of properties, maybe not necessarily the number of rooms.
Okay.
So, as I said, a Ginger branded hotel could be 80 rooms, 120 rooms, 150 rooms, but one Taj could be 300 rooms.
Okay.
One Vivanta could be 250 rooms. So I think we have to look at the mix of the rooms, and we have to also look at the destinations. So it's very important sometimes to even get a 50-room Ginger in Mumbai, because it's important for the brand, and it's not as established as a 115-year-old Taj brand here is established here. So it'll be always a combination of the complete portfolio and how it is going to be positioned in 3 to 5 years from now.
And are there plans for selling off of non-core assets?
Yes, we have announced that. So over the years, we have been collecting a lot. So we would be selling some of the non-core assets, and we have organized.
So what's on the anvil now?
We have collected a lot of, apartments, for example.
Okay.
So maybe we are able to sell some of that. So some of the stuff that is not really useful, or pieces of land which at that time were thought for certain other developments which may not be feasible today. So also in other businesses, whether it's in our flight kitchen business or it's in our, Roots Corporation business, which runs the Ginger brand, there may be opportunities to restructure, what we call the restructure, re-engineer, and reimagine the portfolio.
Now, the New Delhi Municipal Council, that whole case really was fairly long drawn. Would you like to tell us a little bit more about how things shaped up and your views on the final culmination of it?
I don't think it's appropriate for me to comment on that in a television interview. But all I can say is we have participated in all the biddings and will continue to participate with the hope of going out as a winner, because Man Singh truly belongs to the Taj brand, and Taj belongs as a name on top of Man Singh. So let's leave it at that.
What about F&B in terms of the overall revenue contribution? What impact did the highway liquor ban have? What is the outlook on the F&B performance?
F&B is a very important business on the Indian subcontinent. So we are very blessed because the wedding business is very large, the restaurants is large, and there is generally, people like to dine out. I think we are working on some new concepts which we'll be hopefully able to announce in next 3 to 6 months. Like we have done in the past, I think Taj pioneered in some of the food and beverage concepts by doing maybe the best coffee shop that India ever witnessed with Machan and Man Singh, to an Orient Express in Taj Palace, or to Wasabi in this very hotel. So there's or the Zodiac Grill, which used to be here.
Iconic.
Iconic restaurants, and then we came up with the masala series. So I think there is a lot of work happening, and hopefully it will not be just the Indian and the Chinese and the coffee shop business. Maybe there's some other cuisines that we are able to introduce here.
Now, what about the changes in the GST policy? What did that do for the hotel sector as a whole? Because I believe now tax will be levied on the actual transaction value as compared to the earlier policy of tax on the declared tariff. For some of the luxury properties, doesn't make too
I
much of a
think
difference.
it's not about luxury or others. I think this business should be taxed as less as possible. See, globally, any job created in a hotel creates 4 to 8 jobs in the community. And if employment is anybody's strategic initiative, they should tax hotel and tourism business as less as possible. So I think we had some good news on the GST a week or 10 days ago. I hope it will not stop there. In fact, we should encourage tourism, and we should encourage more and more people coming into the country and spending their money here, because we have so much to offer that, having lived a lot of my life outside of India, I can tell you not many other places can compete with such a variety of tourism experiences that we are able to do.
Anyone in the global hotel business industry, as you would know, would tell you that we have great Indian hotel chains, some of the best in the world, but still we find that East Asian hotel companies have gone on to become leaders in hospitality, and there's no reason why the likes of the Taj Group cannot. Why do you think that is?
Can you tell me which company is ahead of us?
No, but
From the Eastern Asian side,
I mean, if we're talking about Shangri-La or some of the other.
How many hotels they have? I don't think even 10 or 15 or 20% of our portfolio. We operate 145 hotels.
So it's a different ballgame.
And a portfolio of 175. So of course it's easier to do with 10 or 15. So if you were to pick up our top 10, 15 assets, I'm sure they are superior to the Eastern Asian chains that you are alluding to. They are wonderful. I mean, there is a place for all. And I think some of them have done exceedingly well, let's say in Paris or London or New York. And we are doing very well in London and New York. We are not in Paris, that's for sure. But it's not on the radar at the moment.
Okay.
So, but we will grow our footprint internationally. And I have always said this, and I am a firm believer, if there is one brand name coming from Indian subcontinent that has the ability to travel to all countries, then that is Taj.
Without a doubt. At the helm, what are your plans to take the company forward? The street or investors have always appreciated, the efforts that have been taken in terms of margin improvement or cost optimization. What are the few things that you would like to do, or changes that you would like to make, or strategies that you would like to drive forward?
Well, we have articulated it in a very simplistic way. We want to stay the most iconic, but we also want to be the most profitable. And that is in all the businesses that we are in, whether it's in our shopping business with Khazana, or it's in our 75 spas with Jiva, or it's in our salons, or it's in our brands like Taj or Ginger or Vivanta or the newly launched Selections. We want to have the leadership position. And wherever we are already leaders, we want to defend that position. Hopefully, at the same time not completely neglecting international growth. So as and when financials make sense, keep planting our flags in the key gateway markets of the world.
Okay, great. Thank you so much for taking time out and joining, and appreciate you joining us on ET
Thank
Now.
you.